So as interest rates remain high and the cost of living in Canada continues to climb to unprecedented levels, we're now seeing an increase in mortgage delinquencies, which some believe might be the start of a ticking financial time bomb here in Canada. Hey, what's going on everyone? It's Griffin here, and in today's video, we're talking Canadian housing market, of course, but with some rather bleak news that's just been released by the credit reporting bureau Equifax, who most of you likely know of for reporting on your credit score. So let's get into it, and if you find value in today's video, please take a second to leave it a like. It's all I ask in return. All right, so before we jump into mortgage delinquencies themselves, let's briefly talk about a parallel factor here that's highly impacting the life of everyday Canadians, and that would be credit card debt. Now, if you aren't aware of this, Canadians hold the highest level of household debt among G7 countries, meaning we highly utilize credit cards, personal lines of credit, auto loans, mortgages, and other forms of debt to fuel our, let's just call it, expensive lifestyles, which are now really starting to catch up with most households, especially considering where inflation's been sitting over the past 2 years, leading to a higher than ever before seen price point for everyday goods and services. In fact, as of the third quarter of 2023, credit card debt reached a new all-time high in this country, fueled of course by the escalating cost of living that's been out of control, putting further pressure on Canadians and leading effectively to a surge in missed loan payments that we're now seeing, including mortgages even, which we're now seeing more of and that we'll cover shortly in this video. According to Equifax though, Canada's latest credit trend report indicates that credit card indebtedness soared to a record $113.4 billion, marking a 16% increase from the previous year. And then over the past 12 months, more than 6 million new credit cards were opened and issued, reflecting a 13.7% rise from the previous year. Again, these values are for Q3 2023. So essentially though, what this means is that people are relying more and more on credit cards to boost their short-term liquidities, let's call them, even though this is a downwards financial spiral if not being paid off adequately. Now, in the broader context of consumer credit though, encompassing credit cards, mortgages, auto loans, and unsecured lines of credit, the total level of Canadian debt has now climbed to a staggering $2.4 trillion, again, as of the third quarter of 2023, which is the latest data that we have available right now for this metric. But let's be honest with ourselves here, things have not improved since then, and this figure is most likely even higher as it stands right now. And to put this into context for you, excluding mortgages here, which sit at $1.8 trillion according to the CMHC's figures, this $2.4 trillion debt level means an average of approximately $21,000 per Canadian for all other forms of debt. That's seriously an insane amount of ongoing debt, where let's say this debt carried an averaged out interest rate of even 12% annually. This would mean over $2,500 a year in interest payments on that debt balance, which is a huge burden that can be difficult to climb out of. And so with interest rates reaching a 20-year high, credit cards have obviously become a primary recourse for Canadians that are grappling with rising living expenses. And I'm still left wondering how the current government can still claim the following over and over.
We know we're in challenging times right now in the world, and that's why it's so important that we have a government that continues to roll up its sleeves and take responsible, serious, steady decisions as we're there to support Canadians now and to build a strong and prosperous future.
But all jokes aside, this is a serious problem that Canadians are increasingly facing, and with mortgage renewals that are on the horizon now for millions of Canadians over the next 12 to 24 months, even having started right now, well, we could very well continue to see credit card balances increase in the future, while mortgage delinquencies do start to creep up. Let's look at that right now. Okay, so according to a recent report released by Equifax as well, mortgage holders in Ontario and British Columbia specifically are starting to increasingly miss payments on mortgages and credit cards as of the fourth quarter of 2023. And as mentioned earlier, this isn't surprising, as throughout the fourth quarter, the ongoing trend persisted, as consumers did grapple with the enduring effects of elevated interest rates and inflation on monthly budgets. But as more individuals renew their mortgages, these effects are increasingly apparent, particularly in regions of Canada where house prices were significantly higher, Ontario and BC respectively, with their GTA and Vancouver markets that went absolutely wild over the pandemic. In fact, in these two provinces, mortgage delinquency rates have increased quite a bit on a percentage basis, now surpassing levels seen even before the pandemic. Of course, levels during the pandemic were very low as buyers locked in extremely low interest rates on their 1, 2, 3, 5-year loans, right? But now, with several months of rates being at 5%, many borrowers who opted for variable rate mortgages, who have seen their trigger rate get hit, will maybe struggling to make up these additional payments that are 100% interest. Okay, but what do these numbers look like? Well, in Ontario, the mortgage delinquency rate experienced a 135% increase compared to the previous year, while British Columbia saw a rise of 62.6%. And in parallel to this, financially stressed homeowners in these two provinces are also increasingly missing other credit payments, according to Equifax, which is a trend primarily driven by homeowners who are below the age of 36 years old. And really that makes sense, as many of the new first-time homebuyers over the past couple of years have been in this younger age bracket, and generally younger people have smaller savings accounts to rely on when times get tough. Furthermore, when times do get tough, the monthly mortgage payment has increased and monthly budgets are tighter. Credit cards and personal lines of credit are often some of the first lines of defense for short-term liquidities, unfortunately, but this only leads to the issues that we spoke about earlier on in the video. So if you're watching this right now and you're able to avoid doing this, make sure that you're always paying off your credit cards and personal lines of credit if you're going to be utilizing them. That is the best course of action, of course, but I know that that is easier said than done. And by the way, outside of British Columbia and Ontario, where house prices and therefore mortgage amounts tend to be quite lower to begin with, Equifax Canada has stated that mortgage delinquency rates are rising at a much slower pace and even remain quite a bit lower than pre-pandemic levels. All right, now, although a 135% increase sounds catastrophic though, let's actually take a look at what this represents on a nominal standpoint, right? Because these values need some added context. So as we can see from this data by the CMHC on mortgage delinquencies by province and per quarter dating all the way back to 2013, we can see that for Ontario, mortgage delinquencies stood at 0.1% as of Q3 2023. Now, we don't have the Q4 data on this just yet from the CMHC, but let's say if we considered what Equifax has now stated being a 135% increase since Q4 2022, well, that would put the current delinquencies at a rate of around 0.16%, which is a big jump, sure, but we do need to consider that the starting point is extremely low and remains way lower than the rest of Canada and even values from pre-pandemic by a long shot, actually. To put this into perspective, there are right around 2 million mortgages in Canada. And let's say if we look at the total delinquency rate for the country as of Q3 2023 from the CMHC data, which stood at 0.15%, well, this means that there are 3,000 mortgages currently in delinquency as of Q3 2023, which I think we can agree isn't much at all, at least for now. And based on the most recent news from the Bank of Canada as of March 6th, they've chosen to hold key interest rates at 5% once again, stating that it's still too soon for rate cuts, mainly under the pretext that inflation has some more ground to make. And that's fair, but as mentioned in my video from last week, speaking about the future of interest rate cuts here in Canada, I still think that we'll be seeing rate cuts by mid-year, as they won't have a choice if not to avoid sinking the Canadian economy further than it's already started to. But despite the shocking doubling delinquency headlines that ultimately don't mean much, as we've just uncovered, and what might be on the horizon for increased mortgage delinquencies in Canada, one thing that is for sure is that Canadians carry way too much consumer debt. And if we don't see interest rates start to decrease by mid-year, I do believe that the delinquency rate could very well increase more dramatically into ranges seen historically in Canada in the 0.5 to maybe even 1% range. But I doubt the government would allow that to take place. Let's hope at least. So what do you think? Are we looking at a mortgage meltdown in our future, or will the Bank of Canada save millions of Canadians from a devastating rate shock? Make sure to comment down below. And by the way, if you want to get up to 4% annual interest rate on your savings, check out NEO using the link down below in this video's description. Additionally, I would highly recommend that you watch one of these two videos right here to learn more about what to do if you do have an upcoming mortgage renewal or whatever else YouTube thinks you'll like on my channel. So thanks a lot for watching. If you enjoyed the video, make sure to leave a like, subscribe to the channel, and on that note, I will see you in the next one.